Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit the subscribe button. Now today we're diving into some major shifts shaping the global economy. We got some sticky inflation, unpredictable commodity prices, and how these factors are driving investment strategies. Now we've seen spot gold recently surge past $26.50 an ounce, and oil jump 3% today as tensions in the Middle East continue to escalate. Of course, we'll be keeping an eye on this developing story. Meanwhile, U.S. job openings just hit a 3-month high. And this creates a pretty complex picture for the markets. While inflation in the U.S. has cooled to 2.5%, some experts believe this is just the calm before another storm, driven by rising energy costs, government spending, and less globalization. Now, our guest today believes we're entering a new economic era, one that resembles the 60s and 70s more than the recent past, where structurally higher inflation and volatile commodity market will play a central role in shaping investment opportunities. Joining us is Philippe Gijsels. He is the Chief Strategy Officer at BNP Paribas Fortis, one of Europe's leading financial institutions, and he's also the co-author of a fantastic book. It's called The New World Economy in 5 Trends. Philippe, welcome to Kitco News.
Good afternoon or good morning, Jeremy. Thank you for having me.
Yeah, we got a little bit of time between us here, Philippe, but let's jump into it. You've kind of mentioned here and throughout the book that we're entering an era of structurally higher inflation and interest rates similar to the 60s, the 70s. As I mentioned off the top, right now, U.S. inflation is sitting at about 2.5%. And while it seems manageable, we've seen energy prices rise significantly. I mean, oil price spiking 3% today on the news of a possible attack on Israel from Iran. Do you believe this inflation is just taking a breather, or where are we at here?
Yeah, absolutely. So the thesis in our book is indeed that after COVID, we entered a totally new world, a world where interest rates and inflation and commodity prices, which are of course linked, will be way higher. But of course, the cycle has turned down. Until recently, the Chinese economy was very weak, or it's still weak, but they're stimulating already. So within these trends of 20 years to the upside of inflation and interest rates, of course, you have downtrends, cycles. So you're walking down a staircase, or you up a staircase, you don't go up in a straight line. From time to time, you come back. And what we tell to companies today, well, this is a massive opportunity. This is almost a gift by the market, because if you believe, as we do, that inflation and interest rates and commodities will be way higher for the next 20 years, but the cycle offers you an opportunity to hedge, well, this is a good time to look if you want to buy a house, to put out a loan. If you want to have an investment project as a company, you can hedge it. If you have a lot of wages to pay, you can hedge inflation and commodity prices. Well, I think we're still at the very first inning of what will be a major bull market in commodities.
Yeah, okay, well, let's unpack a little bit about the inflation side. Why you think it's going to continue to rise in terms of that. I mean, we've seen it cool in recent months. Energy remains volatile. Of course, we mentioned those geopolitical risks, particularly in the Middle East. Could we see energy prices alone reignite inflation, or is this more of a global forces like the supply chain disruptions that we saw?
Yeah. You already mentioned quite a bit of the elements that we discuss about in the book, The New World Economy in 5 Trends. I should show it like this. It's basically indeed a sort about multi-globalization, we call it, but it means maybe less globalization, a world that's no longer centered only around the United States, but with China, with Russia, and indeed that makes that supply chains get shorter. You have indeed the commodity prices that will go higher, and we'll come back to that in a second. You have, of course, the volatile world. You mentioned the Middle East. Governments will have to spend quite a bit on weaponry. They will have to spend a lot on climate change. You have big governments getting involved with everything. So this world resembles way more the 60s and the 70s than does the period from 82 until recently. And then that will indeed have an impact. And to your point, energy prices are probably low. They could go higher as well. But that's not the main reason. I see other commodities doing very well, the metals, for example, because if we move from a world from big oil and big gas to big shovel, where you use electricity. And for that, of course, you need cobalt and lithium and copper and so on. I'm a big bull on copper, for example. Well, that could be the new drivers. And if you're saying in the book, I mentioned somewhere, the copper price could double, and everybody says you're absolutely crazy. But if you go back to the 60s and the 70s, at a certain moment in time, oil prices were $5 or $6, and it went to 100, and it even went to 200. So if a commodity price really starts moving, we all know it can be quite spectacular. So I see shocks. It's not necessarily energy shocks. It could be metal shocks, and that's something totally new.
Okay. Yeah, I want to get into a little bit of the outlook on the precious metal space, particularly those industrial metals, if we in fact come back to manufacturing. But I want to unpack this globalization, the shift away from globalization that you discussed. I mean, governments are stepping in to fill gaps, especially in defense, infrastructure, climate change. I'm curious, it comes as global supply chains have really struggled to recover from the pandemic. And then, of course, you mentioned the Middle East. How does this shift towards less globalization affect global markets and particularly investment strategies?
Yeah, it's huge. It's huge. And our book is a book about books. So one of the books that we mentioned, and you know it probably, is The Fourth Turning, or the update of that. The Fourth Turning is here by Neil Howe. And that's not a very optimistic book. You don't want to read it at the beach. You don't want to read it under the Christmas tree. Maybe Halloween is a good time to read it because it's already dark outside and autumn is getting in. But if you read that book and you look at the world, you say, yeah, he's onto something, because what's a fourth turning? Well, a fourth turning is a period of a lot of conflict within countries. And you see in Europe all the elections that we have had, populist win, the elections in the United States coming up. Unfortunately, there is also a lot of conflict between countries. For the first time in many years, we unfortunately have a war going on in Europe. You have the Middle East, and that's all typical for a fourth turning. And let's say in the 80s, you had the world turning around the United States. The United States could police the world. Everything was under control. There was one superpower. But now you get these different blocks, and there is globalization. Therefore, we do not call it deglobalization. We call it multi-globalization. So it's globalization around a number of poles. But of course, everybody realizes, and then we come back to commodities, of course, that the supply chains are very important. Supply to commodities, which tends to be an issue in Europe because we don't have a lot of it that we mine ourselves. So we, in a way, have to make sure that we get the commodities from other places. But the supply chains get shorter. So you get this nearshoring, you get this friendshoring, and in this way Canada plays a huge role, because Canada, like Australia and other countries in the world, have a lot of commodities, so they will be very important. And therefore I see a big commodity boom coming up also in the miners, because you mentioned gold and silver has been running up in the last couple of weeks, and I think this is only the beginning. But the miners have not yet really followed. I think that will be the next step in the bull market.
Okay, interesting. I mean, a lot of viewers will be happy to hear that, Philippe. I mean, we've been talking about how these prices on the metal hasn't really caught up to the equity side, but I guess, we're coming into a new quarter. We're coming into the end of the year. Maybe we're going to start to see that on the balance sheets?
Yeah, and then there is a lot of disappointment because the miners have lagged for many, many years. And then a lot of people, we had a small bull market, which was demand driven in commodities somewhere 2003 something, when China started demanding a lot of commodities. But the real bull market from the supply side, like we had in the 70s, we have not had yet. And what the point is, there is always a very huge correlation between these markets in miners and so on, and the capital cycle, the investment cycle. And the point is, because nobody cared about the sector too much, there has been underinvestment in copper and all these materials, prices will go up. And what you see is playing out of a classical sequence of events, because you already see the bigger miners, the prices are going up. As their stock prices go up, they can use their equity to start buying smaller players, mid-sized players, junior miners, and so on, to fill the pipeline. And that's what's going to happen. And then you already saw a number of deals happening. If some more happen, everybody will start to look who is next. That could create a flood of capital towards the sector. And if you look at the percentage, what also in the S&P, for example, what energy companies have at the height, it was 12%. Now it's 4%. Miners you cannot even count. It's 1%, 2%. So there is a massive amount of appreciation. And okay, the world that we had was all the money went to Nvidia and a couple of the technology stocks. This can still happen, but I think the market is broadening, and I think these miners and all these commodity players will, uranium, for example, will get their day in the sun.
Yeah, we're seeing lots of talk about nuclear, obviously powering this AI generation. Okay, before, I want to go back there because we, again, talking about the mining equities, I mean, it just seems like we haven't really been seeing it. So I guess my question is do you think, because obviously you represent one of the largest financial institutions in Europe, are you seeing more institutional interest? Are you seeing retail investors pour back into these gold miners? Or are we going to start to see investors come back to the space?
Well, I think we're once again very much in the very first inning of this, because if you look back to the gold price, for example, gold price has been very much correlated with the ETFs all the time, because that's the investment flow. Now, as interest rates went up, and especially real interest rates went up, logically money flowed out of the ETFs. But still the gold price has been going higher because the central banks have been buyers because they want to diversify out of the dollar, out of US treasuries to something else, and that's very often gold. So that has driven the price up, but investors have not been involved. But you see and that's very recent, the last 2-3 weeks, you clearly saw that some money is coming back now. Belgium, Europe is less of an environment for equities, for commodities. So we will be very last in the game. So I expect US investors, maybe Asian investors, Canadian investors, logically, because that's indeed something you're very close to, come back first. And then finally we will realize maybe something is going on and we will jump on the bandwagon. But the moment that we jump on, maybe a lot of the move is already behind us. But this is the very first inning. And I think a lot of people underestimate the potential. I've mentioned 4,000 gold, which is maybe still not very optimistic longer term. But when gold was 1,600, 1,700 per ounce, everybody said you're absolutely crazy. Well, now we're going to 3,000. But that's the way a bull market works. A bull market in commodities is not about 10 or 20%. It's about doubling, tripling, and so on. And I think there's plenty of time to get on board with this.
You almost answered my question there, Philippe. I mean, you're saying 4,000. I was going to get your outlook. I mean, particularly in the short term, could we see 3,000 by the end of the year?
Well, it's always difficult to say what's going to happen. And in the big scheme of things, it's not even that important the way you get to 4,000. But that's not something in 5 or 10 years. It's much nearer in time. Now, we have had a pretty decent run. Also in the month of September, which is typically bad for gold. So in my mind, that's very, very positive. If you can go up in a typically weak month, it's already good. Now, technically, we're overbought. So some sort of a pause, what we've been seeing the last couple of days, and you go back to 2,600 or even 2,500. But I think that all the elements are there. And I was talking about the central banks. They've been buying gold in large quantities. But if you look at their total reserves, the percentage of gold that they only hold, that's historically very low. So I think gradually, they're price sensitive, so maybe they pause a little bit, they wait a little bit, but over the next couple of years, they will continue to buy. And if then investors get aboard, well, then it can go very fast. Now, I think investors are absolutely not over-optimistic on gold. They're absolutely not over-optimistic on the miners. So typically, a run like this ends with euphoria. And we are very far from that, so we have quite a bit to run, I would say. Okay. So good opportunity maybe to pick up at these evaluation prices. I want to keep you on commodities. We need to talk about commodities. But before we do, we were chatting a little bit off the air just before coming to air. And you said that obviously you're the gold bug in Belgium. So it's been quite a run. But you also have Bitcoin on the book. So talk to me a little bit about how important it is to diversify these types of assets and what that new portfolio looks like. Well, Bitcoin, we have no official view as a bank, but in the book we write about it. And I'm a big believer, for example, in the blockchain technology, because in the blockchain technology gives you the opportunity to invest in real assets. And I'm a big believer in a world where inflation runs wild, where central banks keep printing money and putting it in the system to reduce the debt load. That's what they're going to do. That's what they have been doing over the last couple of days and weeks and for years, basically, because it's always the same story. You have to own real assets. If you put money in a bank in cash, you will lose over the next 10 years, easily 50% of your buying power. So you have to go to real assets, and that's real estate, that are equities, that are commodities. In Belgium, that are pigeons, that is wine, that are old timers, all kind of stuff. And maybe what blockchain does, because that's a very interesting point, if you were to be able to travel back in time and would go to Vincent van Gogh, who's a famous painter, but he died in absolute poverty. And now his paintings go for tens of millions or hundreds of millions, so a lot of money, but he never benefited from that. So if you could go to Vincent van Gogh and you could say, look, I give you paint, I give you food, I give you shelter, you give me 15% of your revenue flows, and that's in fact what a smart contract can do. Then basically you can invest in all these things. If somebody wants to write a book, but he cannot find a publisher, well, you could say, I finance you, but I get 20% of the revenue stream. And now we have all on our smartphone with a portfolio of equities. Well, I think in 10, 15 years' time, we will still have a portfolio of equities, but there will also be 10% of the revenue stream of a friend, 15% in a wine cellar somewhere. So this blockchain technology, I'm a big believer, because it will open up markets that at this moment we have no access to.
Yeah, interesting. I mean, you were just talking about it there. You stressed the growing importance of real assets, these equities, real estate, and then, of course, art and wine, which we both like. This could be this new weird economic period that you're talking about. I mean, we got today's U.S. job openings out of the U.S. It jumped to a 3-month high, while the hiring rate dropped to its lowest since 2013. So, I mean, with labor signals this mixed, how should investors approach real assets in this environment?
Well, that's a very difficult one. And I always, this morning we had a presentation with clients, and I always say, we've been doing this for 30 years now. This is by far the most difficult economic cycle to read, because you had the COVID, everything shut down, then there came a lot of money in the system, a lot of savings, then they opened up, then you could spend again, you had the war in Ukraine, so it is extremely complicated, and reading this economy is very difficult. Also reading this job market, because you say that the two variables that you mentioned, they go in different directions. Now, something that I look at, and that's been on your chain mentioned a couple of times, is the unemployment rate. And there is one of this rule of thumb, this algorithm or this heuristic, which in a way says if your unemployment rate goes up 3-4 months in a row, even from a low level, well, typically you have a serious slowdown. So I would still bet the entire market is betting on a soft landing, or official view of the bank is also a soft landing. But I have the feeling maybe this landing could be a little bit harder. But what you see immediately is that the ECB and the Federal Reserve and the Bank of England and now the Chinese, they all come aboard, because nobody wants a slowdown. Because if your problem is a massive debt level, a slowdown is a catastrophe. You certainly do not want deflation, because that makes your debt load even worse. So they want to create a bit of inflation, and the moment that you see the economy going down, immediately you see the central banks and the governments intervening. And that's also one of these elements of this brave new world of higher inflation, higher interest rates. They will intervene. The only way to keep the debt manageable is try to inflate it away. But if they inflate away part of the debt, they can do a lot of things, but they also inflate away your debt. So therefore, I'm still a big believer. Own real assets, own a piece of real estate, put a loan against it, because cash will be inflated away, debt will be inflated away, and what we're left with will be real assets.
Interesting. I mean, we know this well. Governments globally are accumulating more debt, largely, as you mentioned, to fund defense. We got infrastructure. Then there's these climate change initiatives. You've argued just there this point that inflation may be the only way to manage the growing debt. Unpack that a little bit. I mean, with interest rates recently cut by 50 basis points and potential more cuts on the horizon, how do you see inflation and government debt playing out?
Well, if you have a pile of debt like the United States has, but Belgium has, a lot of countries around the world, Japan, it's huge, it's 250% or something of GDP government debt. Well, you can try to grow and save your way out of it. That's the easiest way. But the debt pile is so large, growth has been disappointing for many years. Saving in the way in a world of a fourth turning where the populists win, no central government can ever take the measures that are necessary. So that's one thing you can almost exclude. A second way to get out of it is to default. That's, of course, highly disruptive for financial markets, so you don't want to go there. And the third is inflating it away. And, of course, inflation was sky high. It was 8, 9, 10% in many countries, and some countries even more. That's a problem, because that's a very hard sell to your population, because life becomes ever more expensive and so on. But what they're going to do, the Federal Reserve, the ECB, and then a lot of central banks around the world, they will try to get inflation at a 3-4% level. And they will try to sell it as 2%. And it's an easy sell, because they will say, hey, look, it's an average. So it has been below 2% for many, many years. So now we can have 3 or 4, and on average we have 2. But once again, if you have 3 or 4, let's say 4 for 10 years in a row, and you accumulate that, well, you lose half your purchasing power. But that also means that the real value of the debt has been cut in half. And that's the plan. And your only protection as an investor against that is real assets, commodities, gold, and all the other things that we mentioned.
Mm-hmm. Yeah, that new portfolio, those hard assets, you're thinking they're going to do another 50 basis points by the end of the year, making a complete 1%?
Well, that's a difficult one. And then we heard Jerome Powell only yesterday. And of course, he said, I'm not in a hurry. But then the question I have, if you're not in a hurry, why you cut 50 basis points last time? So it will be data dependent. So it will ECB, Federal Reserve, it will depend on incoming data. And the incoming data will be volatile. So 1 month the data will be better, another month it will be weaker. So it could be 25, it could be 50. But that's not in the big scheme of things so important. I think that we're looking at the end of this year and 2025, I think we easily look at that another 150 to 200 basis points, which would bring the short-term interest rates in the United States around 3%, in Europe 2%. Add to that what the Chinese are doing, and they're really put out the bazooka. It's not a small rifle, it's really the bazooka they took out. So that means a lot of liquidity flowing into the system. So that means gold, commodities, equities will probably do well for the next 6 to 12 months. So that's good news. But after that, inflation will pick up. And then, of course, they will be forced, if it runs wild, to basically hike interest rates again. And at that moment, it can become more complicated for a lot of assets. Because we write in the book, in our world, interest rates is like gravity. When interest rates fall and are zero or are negative, well, everything can fly. When gravity moves up again, well, it becomes more complicated. But that's a problem for the end of 2025 or even beyond. I think we have a sweet spot here at the moment.
Interesting. Okay, so by next year, inflation returns. Could we see central banks tighten monetary policy sooner than expected? Or will the pressure from high government debt prevent them from doing so here? I mean, they got to service a lot of debt at these levels.
Yeah. That's going to be a problem, and some people are not necessarily in that camp, but I want to consider the possibility. A lot of people talk about stagflation, because what are you going to do when inflation takes off again, but growth is still weak? Central banks since 82, since the beginning of the 80s, since the Greenspan era, well, they have been sitting in a nice chair watching the world, and each and every time you had a crisis, whatever, you just lowered interest rates. When interest rates were zero, you started with quantitative easing. And you could do that very easily because there was not an inflationary problem. If you at a certain moment in time inflation were to pick up and growth would still be fairly weak, well, then you have to choose. So being a central banker today is going to be way more challenging than it has been in the last 20, 30 years. So that's an issue. But for me, the moment to become more cautious on a lot of assets would be the moment that indeed inflation picks up. Now, by the way, stagflation is once again something we had back in the 70s. And that was once again a very good environment for commodities and for gold and precious metals as well. Because very often they're correlated. Very often the commodities are also part of the driving force behind the inflation. And if you look at valuations, once again, if you look at the CRB, for example, the commodity index, and compare that to the S&P 500, well, it is an historical low. So I think there is a lot of potential to start appreciating gradually.
Yeah, interesting. So still some sales on out there. Okay, well, we got to talk about this upcoming election, obviously taking place. I was reading the book. If the U.S. government ends up split, it could lead to a legislative gridlock, potentially, right? Especially when it comes to fiscal policies, how they stimulate the economy. Could this inaction hurt the government's ability to respond to new economic challenges?
It could, but on the other hand, it would be something that the market would maybe like, because what the market typically likes is gridlock, because none of the two parties can do whatever they want to do. And on both sides, there are things that could be complicated for markets. The taxes with Kamala Harris, the story about NATO and foreign policy, import tariffs and stuff on the Donald Trump side. So both have their things that markets will not particularly like. So I think a split government, and I think that holds easily 70% probability that none of the two have the presidency and the two houses. That would probably be something that the market would prefer. Now, if you prefer gridlock, then you already know that you're in a world that's politically complicated. If you prefer a government that cannot do too much, well, you already have that foreturning. And in that book that I mentioned, that is not so necessarily optimistic for the next 10 to 15 years. So how do we play the elections? We look at it very carefully in our portfolios. It's clearly a risk factor that we take into account. But it's extremely hard to play, because we all know that if Donald Trump were to win, you want to buy energy stocks, you want to miners, you want to have Bitcoin, you want to have Tesla. If Kamala Harris were to win, you want solar stocks, biotech stocks, and so you can make a list of 10 things on each and every side. But since it's so close, it's almost a flip of a coin. So we look at it, but we don't see really an opportunity, because we have to make a bet on who is going to win. And since this is so close, we can only observe at the moment.
Yeah, it's interesting. I have to ask you, because we're watching these energy prices, really hit inflation. They really shock people, not only at the pumps, but in CPI, PPI. So, we talk about this 3% gain today. It's quite volatile on the WTI crude front. What's happening in the Middle East? There's been a lot of transition talk about this renewable energy and how it's going to be a major focus. Do you think if we manage to get there, it could stabilize energy markets over the long term?
Yeah, I think so. The transition will happen at a certain moment in time, and it's happening. If you look at the price of wind and solar, it's coming down. Now, in the book, we talk extensively about it, and then it's a rather long story, but I will try to cut it short. You have something, what you call an EROI. We all know ROI, return on investment. You have 100, you make 7, so you have 7%. But you could do that for energy. And you should imagine you have a tribe back in the Stone Age. You make spears, you go hunt a mammoth, you kill the mammoth, you cut him up, you bring him back to the village, you cook him, you eat him, you digest him. And then how much energy has that cost, and how much energy has that given you? And that's typically an EROI of about 5. Now, 5 does not look too bad, because that would be 500%. If you do that on an investment, everybody is extremely happy, I think. But that's a world that's not progressing very much. That's the world that we had until, let's say, the Industrial Revolution. And then you move to coal, which is highly polluting, of course. But then you got an EROI of 15. Then you went to oil, EROI of 25. Uranium, by the way, nuclear has an EROI of about 50. I've not put an exact number on solar and wind, because I did not want to stir the discussion, and all the other things are documented. This one, you had to calculate, so this would stir a lot of conflict and discussion. But I would imagine that maybe the EROI at this moment of solar and wind is lower. So the challenge, this would be then the first energy transition in history where you have a lower EROI. So that means the economic cake that's there to distribute, becomes smaller. And the challenge, and that's a hope, and I also believe that, and therefore I talk about the young wizards that have to invent the smart grid and the new batteries of the future and so on. Basically, they have to get this EROI up as quickly as possible. And that's going to happen. We make progress in this battery technology with the solid state, which, by the way, has a lot of silver in it, so that's good for the silver bulls. But this is going to change, but it will take time. And I think, and as a bank, we're very much behind this transition. We invest in it, we promote it, but we have to do it in a way, knowing that there is a fourth turning, which is politically or very complicated, that we do not make things like that and other things worse in doing this. But the technology innovation is at the end of the day the key.
Yeah, and as you mentioned, I mean, a lot of those technologies in this new world come with metals like copper, aluminum, you're talking about silver. What are you most bullish on in terms of commodities over, say, the next year when we talk about this new push forward?
That's a very hard one. But I have to pick two, and if I can, I will have two. I will have silver.
You can pick two.
Because I will have silver because I broke 32 level a couple of days ago. It's been consolidating a little bit, but gold is at its high. Silver touched in history 2 times $50 level. So I think we will go back there and beyond. So I think silver will play catch up also because silver is part industrial, 50%, part precious metal. So I think both will do very well. And then, of course, in the metal space, it's complicated because if tomorrow they invent a new battery that works not longer on lithium but on sodium, you will lose or have much less demand for lithium. So things can happen. We saw what happened in the nickel market, for example. If you have a new way of mining it and processing it, well, all of a sudden prices can drop very heavily. But if you talk about the electrical revolution, the thing I think we will always need is copper to bring electricity from A to B. So for me, the favorite metal to play the energy transition would probably be copper. So I would pick silver and copper.
Yeah, interesting. A lot of people bullish on it. Okay, Philippe, thank you so much for joining us today, sharing your insights on where the global economy is headed, what investors should be focusing. Certainly lots to think about. Some interesting times out there.
Thank you, sir.
I appreciate it. Thank you for your time. And as always, the markets will continue to evolve, and we'll be keeping a close eye on how these trends develop for all of us here at Kitco News. Thank you for watching. Stay tuned. We're going to have more expert analysis, updates on the latest market movements. And of course, we're keeping a close eye on the situation in the Middle East as well. I'm Jeremy Szafron. Thank you for watching, and we'll see you next time.